Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs Fundamentals Analyzer software tool, bringing you another in the subscriber request series. A little over a year ago, October 23rd, 2019 to be precise, I produced an article on Lithia Motors and I titled it Hot Stock on Earnings Beat. And what I was showing, this is what the company looked like, that it was trading at $130 a share. That was on October 22nd. It was trading at a PE of 11.8, offered a yield of 0.92%. High quality A-rated company, and it was undervalued, and yet it had momentum because the stock was already moving back into alignment with fair value. This is what the stock looks like today. I was asked to go ahead and update it because of what happened here. Well, obviously today it trades at $369 a share. The rate of return from that level has been really extraordinary. I'm going to measure that for you by I'm going from September 30th. This was written on October 22nd, so about a month later, but it's about the same price, 130th range. And of course, right after I published this video, the stock dropped precipitously, which obviously was, part of that was what was going on in the world. And then since that time, it's rallied very strongly, and the stock now trades at $369, and that's a 178% growth. Add in dividends, it's about 180% or 112% annualized rate of return. That's really extraordinary. But the reason I agreed to go ahead and follow up with this stock is because it gives me an opportunity to show you how to use this research tool, FastGraphs, a lot more authentically. When you look at this graph, your immediate reaction would be the stock was undervalued, even perhaps with a margin of safety when I published the first article. Again, just to repeat that, to go back here, and look at what it looked like on October 22nd, 2019. And now it's become overvalued. But I do want to show you some of the features. This is a tool to think with, and an analytical tool. So let me shorten the time frame. Before I do that, though, notice that the growth rate of the stock has changed dramatically since coming out of the Great Recession. So let me start by shortening the time frame. All of a sudden now, we have a growth rate of 22%. When I was looking at it from this long range, the growth rate was only 13%, 12.99. And that's because it included some of these lower years and even these lower growth years. But when I shorten that, and I shortened it to a 10-year graph, I want you to notice now I've got the growth rate at 22%. So instead of using a 15 PE, which this blue line is approximating, it's 14.56, which is where the stock looked at, here relative to the blue line, the stock looked overvalued. Well, today, if I'm basing it on this 22% growth rate using the P equals growth rate formula, fair value would be 22 times earnings, or roughly $400 a share-ish. Not perfect response, but ish. So the stock doesn't look as overvalued from this perspective. And this acceleration as growth, I'm going to argue, had a lot to do with this acceleration in the stock price over this time frame. Now, when I go into the forecasting calculator, I do want to point out there are 11 analysts that are following this stock. Now, a couple of important things that have been going on. 6 months ago, these analysts were forecasting a profit of $17.37 for 2021. 3 months ago, they raised that to $20, and then just more recently, they've raised it to $20.50, which is the current estimate. So we're looking at a stock here that is forecast to grow by 13% this year, followed by 11%, and then there's only 2 analysts, but they forecast 28% growth. But when I add up the 55% growth in 2022 with these forecast growths, I get an adjusted operating earnings growth rate of 17.3%, which is what my fair value reference line is drawn on. On that basis, the stock would be well within the valuation corridor. Now, it's not really screamingly attractive like it was a year ago, but it would still not be overvalued. I would still not call this a sell. On the other hand, if I go to the long-term expected growth rate of 22.28%, the stock does look cheap and it has a great deal of opportunity. Now, I can combine the near-term estimates with my tool here by bringing in the estimates and then growing them, but I still get a tremendous amount of upside. Now, checking other sources, let's go into Yahoo Finance here real quick, and let's look at their long-term expected growth rate of the company. It corroborates what we saw from FactSet on FastGraphs of 22.3%. So when I'm looking at this stock, there's your 22.3%. The long-term growth rate would still suggest that this stock is very attractive going forward. It's not as attractive, and it certainly doesn't have the margin of safety it did when I published that first article back in October of 2019. Okay, but for this last year and 3 or 4 months that have gone by now, 5 months maybe, this company has had tremendous performance. The growth has been exceptional, and we're really looking at a stock that has performed relative to the historical growth. I did want to update this for everyone's behalf. I still think this is a very attractive growth stock. It's a little riskier today than it was in October of 2019 when I did the first article, but it's still a stock that has a lot of potential, and it's one that you might want to still take a look at if you're a growth investor, because the future rates of return could be double-digit extraordinary if you buy it even today. But if you bought it when I published that first article, of course, you'd be really sitting in the driver's seat with a stock here that still has a lot of growth potential. It is only double B plus rated, but it only has 31% debt. If you're not familiar with the company, it is essentially a company that owns numerous dealership cars, new cars, also trucks. So Lithia is a really interesting company. It's one of the fastest growing companies, as they say, in the Fortune 500. It's got coast-to-coast automotive retail network, and they reach 92% of the customers. This is their propaganda, or their speaking, if you will. So very interesting stock. I thought it was an interesting update, but I really wanted to show you how you can utilize this tool. Don't just look at a long-term forecast. It's important to run this tool through its machinations. Typically, when you shorten the time frame, you'll see growth rates slowing down. In this case, they're actually accelerating, and you can actually go to the forecasting calculator and use the historical growth rate calculator, hit this little drop down here, and see that earnings growth has actually been accelerating in recent years. And, so it's really a very interesting company, one to look at. A little more risky than it was when I first wrote the article, but it's one that you might want to still consider if your focus is on total return and long-term growth potential. Hey, this has been Chuck Carnevale saying thanks for watching. Hope you enjoyed this subscriber request series update on Lithia Motors Company. Ring the bell, hit the like, and give me all your love. I appreciate it. Look forward to talking to you soon.